All right, Josh, I think we're going to start with just I'll just really quickly start with a quick intro. We're presenting on the recently the IRS issued final regulations for broker reporting. Includes a lot more than just broker reporting. And these are regulations regarding reporting that will take place on 1099 DA. I think Josh will give us a quick intro to different people presenting on the next slides.
Just go real quick so we can get right into the substance. But on the A&M side, we have Chris Kotarba and myself, both of us based in the Miami office. Chris is a managing director. I'm a director, and we work on international tax and as well as digital asset tax services. On the Node 40 side, we have maybe Norm, I'll let you tee that up.
Yeah, I'll tee it up. We have Perry Woodin, who is the CEO and co-founder of Node 40, and Norm Hannawa, head of tax and accounting solutions at Node 40, ex-EY partner. I was at EY for 10 years. Node 40 is a digital asset data analytics platform that provides data that's used for financial statements, accounting, audit, and tax, and potentially even 1099 DA reporting.
Cool.
Okay.
Let's get, I think, here's a roadmap for the stuff we're going to cover today.
Yeah, so just as some background in terms of, I just really quickly want to provide a timeline. In 2021, the IRS, the government, the U.S. government, signed the Infrastructure Act into law that provided reporting by brokers for digital assets that would be similar to like the 1099 you would receive from a broker for sales or exchanges of stock or securities. Those rules went into effect in 21, but the IRS hadn't issued regulations to implement those rules. The IRS and Treasury issued some proposed regs to get commentary from the public community in August of 23. A ton of comments came in. While those comments were being processed in early 24 April, the IRS issued a draft form of this 1099 DA where all this reporting would take place by brokers like Coinbase, Kraken, etc., a bunch of other brokers. That was a draft. Then in July, the IRS, this past July 9, the IRS published the final regulations. The final regulations are limited for they only apply to certain brokers, and the IRS is continuing to study more issues as Josh and Chris will talk about later. So we have final regulations now that cover a bunch of stuff, and then we didn't get this into the deck. The IRS did issue another draft 1099 DA just last week to take into account these final regs, and then lastly, high level key stuff is the regs are effective January 1, 2025. You'll have the brokers will have gross proceeds reporting in 1/1/25 for transactions that take place in starting 1/1/25, and then cost basis and other types of reporting will be required 1/1/26 transactions and going forward. And then on top of that, you'll have layers of more reporting that will take place in 27 and later years. So that's a bit of the timeline.
And Norm, I want to touch on the shift of going from the burden being on really the end user prior to July 9th of this year, and then going into January 1st, they're sharing the burden between the broker and the end user. And then as we go in time, it's going to be more towards the broker side of things. So we're going to be talking about both of those sides today.
And that kind of lends into the next slide, Josh. I'll intro it real quick, and then Chris can provide some more feedback, and Perry. But slide 8, Josh. Okay, so 2 call to actions. I think Perry highlighted them. We're going to go into these later on in our presentation, but the high level calls to action are: first, brokers need to set up systems to try to process all these new rules, including all the reporting, and then second, as Perry mentioned, the IRS not only issued broker rules for broker reporting, but they also had to issue rules regarding how you determine gains, losses, amount realized, cost basis, which digital asset you're treated as selling based off ordering and identification rules. So a trap for the unwary. These regs are not just applicable to brokers. Taxpayers themselves are going to have a lot of due diligence and things to think about going forward, especially starting 1/1/25. So those are the two big call to actions.
Yeah, and stress that date of January 1st, because the people who are keeping their own records may have been doing it incorrectly. And so they do have a few months now to get these in order in time for the requirements that'll take over on January 1.
All right, Josh, kick it over to you and Chris.
Yeah, Chris, anything else about this? I'm gonna get, otherwise I'll get into the definitional
Yeah,
stuff
only thing
real
I would
quick.
say, is that, yeah, just to reiterate the point, it's not enough just to wait for the 1099 to come in and then give that to your CPA. There are new substantive rules here that will affect how you not only report your digital assets, but how you plan for the recognition of these transactions. And so understanding them as well will be very critical to complying properly.
Sounds good. So as a threshold issue here, these final rules about broker reporting of transactions involving digital assets. Threshold issue is what counts as a digital asset. And as we're gonna see, a lot of the provisions outside of the definition are actually gonna do more of the work here, because the definition in the regs kind of just tracks what was already in the statute, which is something along the lines of it's a digital representation of value on a cryptographically secured distributed ledger. And a lot of the comments into the proposed regs were, basically saying the definition was too broad, or there should be more exceptions and so forth. But what's going to be included, sort of your typical scenario, probably the thing most of interest to everyone here is cryptocurrency, obviously. But certain stable coins are also going to fall in that definition, and NFTs. There's a question of like, okay, is it a representation of value or is it value? Either way, it's captured in the definition. What's the public policy behind this reporting in the first place? The IRS and Treasury's position is that it's going to help taxpayers with their compliance, for them to receive the information that's going to be reported under these rules. So yeah, I don't want to dwell too much on the definition, because as I said, a lot of the other provisions are going to kind of give more of the contours of what's going to fall in and outside of the reporting requirements. So with that, I'm going to move on to probably the most important section here is who counts as a broker. Chris, if you want to take that.
Sure. And the only thing I would add on digital assets is that it does not include virtual assets that are used within like a video game or some online platform that exists solely within that ecosystem. It really has to be a type of asset that can come out to exist on the blockchain or a distributed ledger to be traded or sold to be captured by these rules. Probably the most controversial issue in this area is, what is a broker? Who actually has to deal with this reporting? And it all started with the Infrastructure Act, which gave a very broad definition of what a broker is. And the proposed regulations also, kept somewhat of a broad definition as well. Specifically, a person in the ordinary course of their trade or business stands ready to effect sales made by others. What does effect mean? It really means to act as a middleman in a party for the sale of digital assets. A middleman is someone that provides facilitative services with respect to sales of digital assets. But what a facilitative service is got sort of deferred for now. But long story short, there's certain categories of companies within the crypto space that are considered brokers. One is a custodial industry participant. We'll talk about what that is. What was excluded for now are non-custodial industry participants. We'll talk about what those are. PDAPs stands for Processors of Digital Asset Payments. Those, for the most part, are included in here, although not to the extent as the proposed regulations. But there are certain exemptions that were kept in the final regulations. So if you're just a validator or a miner for blockchain transactions, you are not subject to these reporting requirements. That's clear. Similarly, if you provide hardware such as a cold wallet and don't provide any other services for customers, you're excluded from this. Or if you license software that's involved with exchanges of digital assets, you also are excluded. Those are kept over from the proposed regulations. So we sort of have a smaller universe than before, but potentially could get much broader as more and more guidance is provided. Next slide. Okay, so what is a custodial industry participant? It's a participant who takes possession of customers' digital assets or acts as principals or counterparties or agents. So basically anyone who is a custodian of digital assets. That would include digital asset trading platforms such as centralized exchanges. That includes hosted wallet providers. That also includes digital asset kiosk. And the policy behind this is really that these actors have the information about their customers required to properly provide information about gross proceeds and cost basis, and they can easily gather and provide this information to customers. So that's very clear. And by the way, there hasn't been much objection from the centralized exchange community about this. They're actually okay with these reporting requirements. What it was excluded for now are non-custodial industry participants. These are, providers of facilitative services that affect digital asset sales. But what the regulations say is that IRS and Treasury need to think a bit more about how to apply the rules to these actors, who would include decentralized exchanges, or what we call DEXs, unhosted wallet providers, other decentralized platforms. And it was a little too tough in the short amount of time for Treasury and IRS to come up with guidance for these types of companies. However, they were very clear that they think the broker rules still apply to DeFi, to DEXs, but they did seem more time to understand how the rules should be set out for these. So we expect more guidance to come in the future on this. Maybe later this year we'll see. But for now, at least, DeFi doesn't have to, as of 1/1/25, start tracking and reporting digital asset transactions. The other thing I'll mention, going back, is they also reserve on non-US and foreign digital asset brokers whether they need to report transactions for their US customers. That also is pending further guidance from IRS and Treasury on how the rules should apply to foreign and non-US brokers, in particular because the OECD had adopted its own sort of reporting regime called CARF, which is being enacted by other countries to be effective 2027. And the US is very clear that we are going to adopt CARF in the US as well, and it needs to work together so that there's sort of a global reporting regime for all digital asset transactions and all customers worldwide. So they need to sort of work together, and our government needs more time to figure out how that's going to come into play. And then finally, on PDAPs, which again are processors of digital payments. These are persons who enable buyers to make payments to merchants using digital assets. sometimes the buyer pays the asset to the PDAP. Sometimes the PDAP doesn't take custody of the asset. And so now, again, just like before, we're separating PDAPs into who are custodial and non-custodial processes or digital payments. And therefore, if you are a PDAP, but you have information under anti-money laundering rules, then you are able to report that information to the IRS. So this area got a little bit more complicated in the final regulations, but it is still applicable, and processors who are doing these types of transactions need to be aware of them.
Chris, can I say one quick thing about that?
Sure.
I think a lot of times the person disposing of the asset, the digital asset, is not necessarily a customer of the PDAP. It's the merchant that's the customer of the PDAP. But if you look in the regs, those the definition of customer is going to be a little bit broader. So if the PDAP has any kind of arrangement, I think was the term, with the customer, with the person disposing of the digital asset, they would have that customer relationship. And an arrangement can be something as simple as like an app, a computer or mobile app provided by the PDAP. So I got to think a little more broadly about that.
Yep, agree.
Yeah. But next point. Okay, cool. So what was a digital asset? Who counts as a broker? That's great. What's next is, okay, what counts as a sale that would then trigger all these reporting requirements here? And it's, again, pretty straightforward. Any kind of disposition of your digital asset. And again, think a little bit more broadly, because it can also include things like a swap for one digital asset in exchange for another, subject to some exceptions we'll see in a sec, or payments through a third party like a PDAP that we just talked about, or payments of a digital asset in settlement of some kind of derivative like an option or something like that. More interesting is what doesn't count. And so in the regs, there's a few exceptions. Two notable ones here would be if the broker holds on to some digital assets of the customer in order to cover that customer's transaction cost. That's exempt from reporting, or it doesn't count as a sale, let's say, for purposes of reporting. Sort of similarly, backup withholding, which we'll talk about a little bit later. If the broker disposes of digital assets in order to meet that backup withholding requirement, that again won't count. And then another thing is, I think Chris mentioned earlier too, is the closed loop assets. So things like loyalty, reward programs inside a closed system, or the video game assets that aren't really tradable outside that system. Issuance of those digital assets is not going to count. And then at the same time that these final regs came out, the IRS and Treasury published this Notice 2024-57, which gives you 6 more transactions, let's say, that are exempt from reporting. And the government made it pretty clear they don't want you reading into it too much as far as the tax consequences or the tax characterization of this. It's just to say these are not subject to reporting right now, or there's no penalty for not reporting. I don't think we have time to go through all of these, but just real quick, wrapping and unwrapping transactions. If you take a digital asset that's native to one ledger, change it for one outside, exchange it for basically an identical digital asset that's on another system, that potentially won't count. Liquidity provider transactions, where you transfer your digital asset in exchange for another one that represents an interest in a pool of digital assets, and you do that for the purpose of facilitating trading. That's exempt under this notice. Probably a real big one is staking, or proof of stake, or validating, where you transfer a digital asset, smart contract as part of a validating proof of stake mechanism. I guess the idea there is you potentially get that back along with reward points for participating in the validating mechanism. That's going to be exempt. So, like I said, there's these exemptions here under the notice.
Yeah, and I was just going to say, Josh, on these, I think they didn't want to necessarily take a final position as to whether these gave rise to sales or exchanges. That people,
Yeah.
Various people like you guys at A&M maybe take positions based off of common law or regular tax principles, but they're still studying these. And I guess theoretically, once they get final rules on these points, it can easily be put into various reporting type regulations.
That's exactly right. They're basically saying, hey, we're holding these aside while we continue to study. Whereas some of the ones under the regs, it's it's an exception from the definition of sales. This one under the notice, it's more the tone of it is basically like these are exempted from any kind of penalties for non-reporting. The effect is the same. It basically carved out from being sales for purposes of having to report them. Let's see here. So, all right. We know what a digital asset is. We know who a broker is, and potentially some of the things that fall under the definition of sales. So next question, who cares what gets reported, right? Norm, Perry.
Yeah, I'll go over this briefly, and Perry and I can go over the details in terms of the data. So, and I'm going to go high level here. We can obviously spend a whole hour on just what gets reported, but initially starting January 1, 2025, if a taxpayer that's on a centralized exchange, an example, engages in a sale or exchange transaction on January 1, 25 or forward, the broker has to report the gross proceeds and various other items with regard to that transaction. I think the key is that it's gross proceeds reporting starting January 1, 2025. Those reports actually get prepared on a 1099 DA in 26, but they deal with transactions taking place in 25. Also in 25, brokers do need to give some information to the IRS, much more limited information. The proposed regs, one of the final regs require brokers to tell the IRS some information about what digital asset was transferred into a broker. So as of right now, we don't have, as Chris and Josh mentioned, we don't have broker reporting from things like Dexis or non-custodial wallet providers. We also don't even have coordinated reporting from exchanges like Kraken and Coinbase. So if a taxpayer transferred from a Kraken to a Coinbase or from like a non-custodial wallet to Coinbase, that centralized exchange would need to provide the IRS with some information on that transfer in, starting 1/1/25. Starting 1/1/26 for a very specific class of digital assets called covered securities, which high level include a bunch of, there's a list of what those are, but high level there would be digital assets that were sold after 26 that the taxpayer acquired by the broker for that taxpayer on or after January 1, 2026. So if I, as a Coinbase customer, acquired a digital asset on January 10th, 2026, and I sold it sometime in 2026, the broker would have to report cost basis. That's the first year that cost basis reporting has to be tracked by the broker and then theoretically reported sometime in 27. So that's the key rule in 26. Just as a quick point on those particular three rules, I just do want to note that first, the brokers, they have only so much information at their disposal, right? They know what happened on that broker's platform. And so the rules did envision that there could be information provided by customers to brokers. Like if you transferred in a digital asset, and you want to tell the broker, hey, you may see this as acquired on 1/1/25, but I actually acquired it before that. Here's my information broker on when I actually acquired it, because that could mean I have a long-term gain instead of a short-term gain if I sell it on that broker's platform. The rules envision that customer provided information, the brokers could take that into account. Here, we'll get into this. Our system set up for that? Not yet. Number two, just a note on those particular dates, there were some exceptions provided as in the final regs with regards to data that was originally required in the proposed regs. For private the key points here is for privacy purposes. The IRS no longer requires transaction IDs or wallet addresses or the timestamps of particular transactions to be reported by a broker. Some of that data needs to be kept by a broker in its own repository for 7 years, but they're not going to be put onto a 1099 DA. And that was for privacy and maybe cybersecurity type reasons. It's just another place where someone could potentially steal that information. And then lastly, again, we can spend a lot of time on this, but in order to reduce the potential reporting that's required, the rules envision, number one, aggregate reporting for PDAPs and stablecoins, so that you effectively, instead of reporting every single possible transaction that takes place on some sort of a PDAP or a stablecoin, you can the broker could aggregate all those transactions in one 1099 DA, thereby reducing the possibilities of having more DAs that the IRS has to deal with and the broker has to deal with. Second, in response to some comments regarding the fact that these transactions may not generate large gains or losses, the IRS also provided some de minimis thresholds for stablecoin and NFT reporting. I.e., the broker only needs to report if that particular customer's stablecoin or NFT transactions exceeded a certain amount. And the policy behind all that is just to reduce the burden for these transactions that they may not give rise to large gains or losses. I think, Perry, I think I hit the main points there, at least as to what needs to be reported.
Yeah, and I want to start with the de minimis exemptions first, because I think a lot of people think when they hear that is great, we don't have to do the record keeping. That's really on the broker. So the broker doesn't have to report these small transactions, but you as a taxpayer, you as an end user, still need to track all this information. And so Norm touched on this, but there's a big disparity between what the taxpayer knows and what the exchange knows. And there will be a shift over time as to what the exchange is required to know. But we can lay out what some of these disparities are. One, the taxpayer knows what tax lots they have, what the basis of each tax lot is, what their lot relief methodology is, and how long they've held each tax lot. These are things that the exchanges don't know unless that transaction happened within their domain. So that can be problematic, and the reason that's problematic is prior to January 1st, 2025, so a few months from now, we would see people selecting tax lots after the fact. So what that means is they were selecting the lots that they were disposing of after they had formed the transaction, because they were trying to optimize their tax liability. That seemed to be maybe okay prior to these regs coming out, but it is most certainly not okay now. So now your lot relief methodology has to be you have to decide on that prior to the transaction taking place. So what does this mean? It means that there are going to be taxpayers that see this opportunity, and I know we're going to talk about the RefProc in a little bit, but there will be taxpayers this year that see the opportunity to start saying, this is my relief methodology. Maybe I'm specifically identifying the lots I want to get rid of, or I'm selecting a methodology that's my standing order. But the exchanges, as Norm said, are still not accepting that information. So I think that is the next step where the exchanges the broker will want to know what lots are you relieving, what is the basis of those lots, and then everything starts to fall in place as these regs gain or have more teeth in the future. All right,
Right.
Norm, anything else?
Perry, maybe for some of those that are new to this area, can you explain what a tax lot is?
Yeah. So as you are acquiring these digital assets, you're acquiring them over time. And each time you acquire them, they have a different cost basis, means you bought them at a different price because we've got a lot of volatility here in this industry. So you want to track the price of the asset when you received it and the amount of time that you've held that asset. So each one of these component parts is a tax lot. It's uniquely tied to date acquired and the value that you acquired it at. The complexity comes into play when you are moving these things around. So the value needs to be carried between your various accounts, and only you, as the taxpayer, currently know that. That answer, Chris?
Yep, thanks.
Great.
I think that turns us effectively into that, Josh, the first call to action, rehashing that slide I mentioned earlier. The brokers we've mentioned two calls to action, taxpayer side and the broker side. We've alluded to both of them here. Brokers have a big call to action in terms of determining, are you a broker, which Chris went over earlier, and there's a lot of detailed rules on that. If you are, confirming that your systems for actually tracking these people, the KYC, the AML, the identification with respect to that particular taxpayer, TIN, social security number, whatever that may be, the actual 1099 DA prep, and this tax lot data needs to be processed. Overall, the general theme is systems analysis needs to be done from an advisory standpoint, and systems now need to be set up to try to do this, even if the broker is just basically complying with the basic rules.
Yeah. So Norm, what happens if they don't get all of this set up, and we know they're not going to be able to within a few months, but they're going to go towards that. If they don't get it set up, there's going to be this big disparity between what the broker reports and the expectation of the taxpayer. That could lead to some unhappy customers. So I expect that a lot of these brokers are going to be looking for guidance from the likes of A&M to really fully understand, hey, what positions me to fall in line with the regs, but also what can I do to help my customers and sort of bring value add there so that we're all in alignment.
Yeah, and part of this is tracking the transactional data, which these guys at Node 40 are great at doing. But another big part of this for brokers is the customer data itself, knowing the names, the addresses, social security numbers, and not only just getting that from the customer, but also verifying that it's accurate with the IRS, as well is going to be important for properly reporting these forms, and a lot of that data may not be currently available, so you may need to update your systems to now start collecting more customer data as well. And with that comes various customer data legal rules, GDPR and privacy rules that have to be taken into account. So it's a big undertaking that's being asked here.
Great. It's a real sort of administrative burden, or it's really a big lift. And it's one of those things where you really want to make sure you get your systems down on a day-to-day before these rules really switch on, so that you're not put in a crunch after the fact.
And Josh, let's not forget, this is blockchain data, so it's all programmatic, so it's all accessible to us, and we can apply algorithms to it to get the answers. So while it's a big lift because it's something new and we haven't done it before, the precision that we're able to do in this industry is unmatched anywhere else.
Yep. And if everything's set up at the outset, it should be a real smooth sort of process. Perry, Norm, do you want to sort of continue on that
Yeah,
line,
let me.
and say a little more about gain and loss determination?
Yeah, the IRS, outside of the broker reporting rules, which are like the information reporting rules, in order to tell the broker, in order to provide guidance on both sides, the broker and the taxpayer, as to what to report, the IRS did need to now provide much more clarity with respect to the how to determine a gain loss, what is your amount realized, and what is your cost basis, and how to allocate fees. And those are in the regular income tax regulations. So the IRS did issue final regulations under 1001 and 1012 regarding those rules. I'll go over those briefly, and I think this is a really, really interesting area. But high level, with regards to amount realized, the the IRS kind of provided a nice one for the taxpayers in terms of if a taxpayer sells a digital asset for cash or another digital asset, like I sell my Ethereum for USDC, which is another digital asset, a stable coin, the amount realized is under the normal rules, the fair market value of the property you received less your digital asset transaction costs. So costs were allocated to reduce the amount realized on most transactions. Where a digital asset is sold for another digital asset, in the proposed regs, there was a bit of a conundrum for the IRS because really the idea they didn't know whether to allocate that to the digital asset sold or the digital asset acquired. So in the proposed regs, they try to take a 50-50 split, which was allocate the fees to both 50-50, the digital asset sold and the digital asset acquired. A lot of people had comments saying, hey, that's incredibly complex. So the IRS did give one here to the taxpayers, in my opinion. If I sell my Ethereum, my digital asset, for another digital asset, a stable coin, I get to allocate the transaction cost to the Ethereum sold. And that's the basic rules. Now, if I buy a digital asset with something like cash, I get onto Kraken and I use cash to buy a digital asset, the fees that I'm charged for that transaction get actually allocated to the digital asset received. So high level, the IRS provided a lot more detailed rules that we didn't have before with regards to allocating fees to these various digital asset transactions. And going forward, starting 1/1/25, any platform you're dealing with is going to have to do that correctly. Even though fees can add up, the brokers will have to report the fees this way. And so the taxpayer is also going to want to report the fees in the same way the brokers does, because these are final regs. I think outside of that, the bigger, more important rule is how do you identify which digital asset you sold? So Perry talked a little bit earlier about tax lots. And here I'm really looking at, Josh, just because I don't have the slides, I'm really looking at slide 32. But we have a great picture of what a tax lot looks like, so people can kind of visualize it in a couple of slides going forward. But if I have bought Ethereum at various dates in time, let's just say 26, 27, 28, I have multiple lots of Ethereum. And the question is, which lot of Ethereum am I deemed to sell when I sell Ethereum on this broker's platform? The basic rule, high level, is whether I'm selling on a broker's platform or a non-custodial wallet, like my own MetaMask wallet or whatever it might be, if I'm selling using that software program. The rules say now you must apply FIFO going forward, starting 1/1/25 as the default rule. A taxpayer is allowed, however, to apply specific ID. So to say, I don't want to apply the default rule. I want to actually say I sold this particular unit of Ethereum. That is allowed if the taxpayer makes that specific identification before the transaction. And that's a really key point here. Unlike the prior days where it was a little more Wild West and you could come back, you could come in and start looking at your analysis on October 14th, the day before you filed your tax return, and try to figure this all out after the transactions. Here you have to do this before the transactions. With a custodial broker, it's the rules do envision a situation where the brokers may set up systems to allow taxpayers to do that, or to get data to do that, to instruct the broker on which of those specific IDs you're making before the transaction. And on a non-custodial platform like your own custodial your own hard wallet, you have to keep records as a taxpayer of those specific identifications beforehand. And there's a bunch of rules, a long list of rules. This is on how you make that specific ID, whether through a standing order, the type of data you need to maintain to make that to actually justify those positions, etc. So the bottom line going forward here is there's a lot more specific rules on how you determine a gain or loss, how you allocate fees, and how you determine the exact unit of digital assets sold. They're not going to allow you any longer to take positions after the fact. Lastly, one last point here. I'll mention it briefly, and then we'll kind of go into like the call to action here, and get Perry's viewpoints on these. Is that the IRS under this RevProc 2024-28 did take into account that perhaps their rules were not clear enough in the past, and taxpayers may have taken positions applying much more flexible tax lot identification methodologies. One example would be if I owned assets on both Kraken and Coinbase, and I sold the same exact asset on Coinbase, but I said, hey, you know what? I want to actually, through my books and records, treat it as selling the asset I held on Kraken, even though I didn't really sell it on Kraken. The IRS has acknowledged that people may have done that, and they provided a safe harbor under this RevProc 2024-28 for allowing a reasonable allocation of the unused basis using that, like, let's call it universal methodology, allocating that unused basis on the different wallets or sources or centralized exchange platforms where you may have held those assets to the assets that you hold going forward. So if you held an asset pre-1/1/25 and you bought it pre-1/1/25 and you continue to hold it after 1/1/25, it's possible to apply this RevProc to take some sort of a reasonable allocation if you had used these universal asset methodologies. There are a lot of very, very specific rules on doing that. I think a couple key points is the allocation must be reasonable. There has to be records that have to be kept. There's a bunch of timing rules on when those allocations have to be made. And a very important point is those allocations are irrevocable. Absent those allocations, really these identification rules I mentioned earlier, spec ID before transaction or FIFO apply starting 1/1/25.
Norm, I love the way you phrased that, that the IRS realized that people may have been doing this. We know they were absolutely doing this because we talk to people all the time that say, "Oh, now I've got to clean up this mess that I made for myself." So this is the burden on the taxpayer, but also think about brokers who have assets on their balance sheet. It's the same problem. Now they may not have that reporting issue on behalf of the taxpayer, but they're taxpayers themselves, so they have to get their books in order. So I think the call to action for the taxpayers is stop doing this stuff manually. I mean, really get a system in place that allows you to understand the different sources you are interacting with, whether this is on chain transactions or from exchanges, what the cost basis and the tax lots of each one of those are. And then I would say at this point, you can take that position. You can default to FIFO, like Norm said, which is what the regs are requiring. Or prior to forming transactions, you can identify the lots you want. You just need to know what those are. So you need some sort of robust, repeatable methodology to help you do that. I think it's only a matter of time before the brokers implement something, because we are talking to some of them now, that allows them to take in that information as a standing order from the taxpayer. So what that means is I might have some Ethereum on an exchange. I happen to know what those tax lots are. I want to dispose of specific tax lots in the next transaction. So I would have a standing order that I submit to the broker and says, when this transaction takes place, these are the lots I have identified prior to the transaction that I want you to use. So it's really only a matter of time before people implement this, because some of the larger clients for sure are going to be requesting and requiring this of their brokers.
Absolutely. I think the next thing here to keep in mind is, yes, this is all, these rules are all federal tax law, but there's a cross-border sort of overlay to all of this. That takes us to this idea of the rules regarding exempt foreign persons. Chris, if you wanted to
Sure.
take
So
that away.
we talked before about non-US digital asset brokers, and that guidance with respect to them is going to be coming later. Same thing for non-US brokers who are CFCs or controlled foreign corporations. Guidance with respect to them is going to be coming later as well. So just for purposes of this reg package, we're only talking about US digital asset brokers. But what do US digital asset brokers have to report? It's really only transactions for US customers. If you are a foreign person using a US broker platform, the broker may not have to report data with respect to those transactions. However, how do you prove that your customer is a foreign person and thus exempt from these requirements? You do have to get a Form W-8 from the customer. That's the first step, again, which is something new that hasn't been done yet. But not only that, you have to actually be sure that you can rely on the information provided by your customer, that it's accurate. And there's certain indicia that the regulations use to, determine whether the information is reliable or not. Now, some of that indicia is the same that securities brokers use, like if you have a US address or a US phone number, you may not actually be an exempt foreign person. The good news is that they took out a lot of the extra indicia from the proposed regulations, which were trying to say if you're using a US IP address or a US VPN, then you also may not be an exempt foreign person. That's out. So it's the same information that we typically use already, which again is mostly if you have an address or phone number in the US. If you are not sure that your person, that your customer is exempt, you may have a backup withholding obligation with respect to them. And Josh, I think turn it over to you to explain more about what backup withholding is.
Yeah, sure. And just keeping an eye on the clock here. I think the thing to say about backup withholding is just to make clear that the rules are just making clear that backup withholding applies to these transactions involving digital assets. So what is backup withholding again? For certain reportable payments, the code requires the payor to withhold at the statutory backup withholding rate, which is currently 24%. And so now that's going to apply to, or that applies to transactions involving digital assets. A couple points on that is that there's some penalty relief, at least for the time being. So for transactions during the year 2025, no backup withholding. And then for transactions during the year 2026. Also exempt as long as the broker provides to the IRS the identifying information of the payee. So name, taxpayer identification number, and so forth. I think that ties into the penalties as well. Chris, if you wanted to say a little more about that.
Sure. So if you're a broker and you have these obligations, can you just not comply and get away with it? The answer is probably not. The penalties are steep, up to $250 per form every year, capped at $3 million per year, which for separate reporting for each transaction, with some exceptions, that can add up pretty quickly. So there's steep financial penalties for non-compliance. In addition, the IRS has really bumped up its enforcement in this area. It's hired lots of new crypto specialists, and it has new funding from Congress to go after non-compliance. So, long gone are the days where you can hide and just pretend that, you only exist on the blockchain. So it's now is the time to comply, and really it's urgent because January 1 is coming quickly.
So closing thoughts. I know that was a lot to cover here. I think a good thing to sort of take away is the dates, right? And the dates that you got to make sure that you have in mind to worry about these things. Here we have a timeline here, or sort of a matrix showing the main dates for when these rules switch on.
Yeah. Agree. It's just a basic matrix, but again, January 125 is when the rules switch on. There's additional reporting in 26, and there's a graduated scale where the stuff Chris was mentioning, like, some of the relief from these backup withholding and penalty rules start to go away. So they did give some relief in the early years for the brokers, and then that relief starts to go away.
But it's coming up fast, right? We're 4.5 months out, and there's a burden on both sides. So yeah, start now.
Yep.
Absolutely. Sorry, Norm, what was that?
Oh, that's it.
Yep. Here's an example of what the draft form looks like.
Yeah, I think the key here, it just came out. It's still a draft. I'll just go into, there's a lot of additions and subtractions, but what I found interesting is they did add the points on stablecoins and NFTs. They added the checkbox on if the broker relies on customer provided information. Going to Perry's point earlier, most likely what the broker is reporting for a lot of taxpayers that are not just doing activities solely on one exchange or are engaging in any high volume transactions outside of one broker, or they're doing DeFi, participating in their own transactions through their own custodial wallets that they hold, unhosted wallets. For most of those people, the broker rules, in my opinion, the broker reporting will probably be wrong. And then there'll be a question of how do you take a position, either telling the broker that you have different information and hoping the broker reports it, or relying on your own information to support a position that is different than what is reported to the IRS on the 1099.
Yeah, it's a big open question, right, Norm? Is what is that reconciliation process going to look like?
Yeah.
That's everything.
Right on time.
Yeah,
Yep.
thanks, Josh.
Kept us going,
Anyway,
Josh.
Yep. Thank you guys all for listening in. Here's our contact information. Hopefully, if you guys have any questions, you'll reach out to us. We look forward to hearing from you.
Thanks, everyone.
Yeah, thanks.
Bye, everyone. Thanks a lot.